Hey, hi. So, we had a very terrible day yesterday, Wednesday, which is because of the Fitch ratings and causes market to really tumble, especially the Nasdaq stocks as well as the Russell mid to small cap growth stocks as well. Those risk assets. I just want to show you today what are the sectors that I believe that still have upside. I understand that many of us think that the market is a little bit frothy and a retracement should happen and all that. I'm a slightly of a contrarian view, thinking that so far only the Magnificent Seven has actually pushed up the S&P 500 and the Nasdaq index. As you can see, companies like Disney and all that still at COVID lows, 2020 lows and all that. So it's like companies like PayPal and all that, 2019 lows, and even though their revenue has increased a lot. So I don't think that the market is frothy, and I just want to show you this software index, mean index as well. The mean index is 7.7. We are still now around 6.6-ish, and it can always go up to about 2%. There's still quite a lot of room to growth. Of course, software index companies mostly are in the Russell's index, and some may not be profitable yet. But looking at 2023, quite a significant number of companies like, for me, Palantir, Robinhood and all that may have potential for to become GAAP profitable on the first quarter ever. And software provider as well as software platform can be, SaaS is actually quite wide a term, SaaS. So it can cover companies like even Grab and Uber as well, which has a moat. So I just want to show you an interesting video here about what these experts like Chamath and all that thinks about the software index.
7.7, excluding the weaker stocks are rallying, is what the market is thinking is, well, if inflation is down to 3% and we can end the year at 3 or even lower, then the Fed can start cutting next year. And so they're starting to price in rate cuts. But if inflation comes roaring back, you're not going to get rate cuts, and so stock prices are going to go down. I don't see how you can have a scenario of even higher interest rates from here along with higher stock prices. I think you need lower rates to get higher stock prices. And one of Brad's charts shows this. If you look at the software index, the median enterprise value divided by next 12 months revenue, what you see here is that the mean multiple is 7.7, excluding the COVID distortion. We're at 6.6 now. So there is room for the software index to run up pretty nicely here. You could argue that's undervalued or fairly valued. You see the 10 years at 3.8%. If you compare it to where we were before COVID, when interest rates were in the mid twos to around 3%.
Yeah, we got to an 18x multiple. It was crazy.
Yeah, so basically, if interest rates go down, I think for sure you'll see multiples go up. But I think if interest rates are going to keep going up from here, then you're not going to get that rally, or I don't see why you would.
Well, the thing to keep in mind is I think this chart is not that helpful because this is all unprofitable software companies. So I think the more important thing is to look at the broad-based index. The thing with these companies is that even if rates are at 3% or 6% or 2% or 1%, that trick is over. These companies are not going to get out of this cul-de-sac until they figure out true product market fit, how to eliminate churn, how to drive medium to long-term profitability. And most of them, unfortunately, don't have a clear path to that. And the problem is all of the old legacy software companies, X of Salesforce, have still not got to profitability. So meaning the ones that went public in like the early teens are still sucking wind, losing money. So the idea that software businesses generate long-term profits has so far, unfortunately, been a fallacy. So that chart I think will stay exactly the same way it is. I think the bloom is off the rose. But where the money can go
What would change that, though, Chamath? Because we need to stop at this point to talk about these SaaS companies, because what would change that if they actually get to profitability? And Sachs, what's the chances they get to profitability? Because that would make them look more like Microsoft or...
The biggest problem that software as a service businesses have is the same thing that it benefits from, which is cycle time. So the cycle time for a SaaS business to build a feature set, to get product market fit, and to get early revenue is very short. The problem with that is the equivalent amount of time it takes for a competitor or several competitors to compartmentalize and chop and slice and dice that feature set into a bunch of smaller subscale SaaS products that then go after it and cannibalize that revenue. So I think the issue that they have is they show contractually a lot of revenue expansion that looks good on the surface, but underneath, these guys are in this constant hamster wheel of trying to build features and trying to keep their head above water. And all of that treading consumes enormous amounts of cash. And so from an OpEx perspective, these SaaS businesses, they just suck. They don't generate free cash flow, except for a few.
Let me bring Sachs into this. Sachs, do you think that these companies will get to having a PE ratio? Because a lot of times you pull them up and it's like price to earnings ratio not applicable for this company because there are no earnings, and you've dedicated.
Yeah, so you can see what Chamath says quite true. You know, the stock picking skills is quite important to be able to get the needle from the haystack. You know, find the needle from the haystack. Kind of the companies that are only a few that have a true product fit and generate positive cash flow and can get profitable as well. And of course, with AI, that would be able to help them to reduce OpEx costs as well. And now the importance of data, especially proprietary data. The larger the data that they have, the bigger the chances they are able to remain a very sticky platform for consumer to continue using and all that. So, or a software that is very sticky, very hard for people to do a migration to another software like Palantir, for example, or Microsoft or Google. So you just get so used to using those products, or services. So so that's all I can say for now. It's going to maybe a turbulent August because of the Fitch re-ratings of the US debts and all that. So hope you like the channel, and please like and subscribe. Thank you.